The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to today's webinar. I'm Nick Zulovich, part of the team at Cherokee Media Group and senior editor of Subprime Auto Finance News. In today's webinar, insurance monitoring using data to improve recoveries and enhance borrower and collection strategy, we're going to learn more from Dennis Brosnan and Steve Garcia with Diamond. But before we get started, I want to go over a few housekeeping items for today's webinar. Please make sure you've dialed in using the phone number provided in your communication email, or you're able to listen via your PC speakers. We are recording today's webinar, and we'll make the recording available to you as soon as possible. You will be in listen-only mode for the webinar, but we will reserve some time after the presentation for a Q&A segment. You can submit your questions at any time through the questions box on the GoToWebinar control panel. And if we aren't able to get to your question today, don't worry, because we'll forward it on to the team at Diamond so they can respond back to you directly via email. And lastly, if you have any problems during our webinar, please click on the hand icon to alert a member of our team. So with plenty of knowledge and recommendations to share, let's get right to Dennis and Steve for our webinar. Gentlemen, the floor is now yours.
Hey, thanks, Nick. Dennis Brosnan. I'm the president and CEO of DeMont, and we appreciate everyone logging in today. This has been probably the third or fourth webinar that we've done this year, and this is part of a series where we're talking about issues relating to third-party recoveries on auto insurance loans. And today we're talking about insurance monitoring, as Nick said. Now, the great thing about webinars, if you've never done one, is that, hey, you get access to a lot of great people like Steve and Diana and Brian without having to get on an airplane or buy a conference badge or anything like that. And from our perspective, anybody can do it. I love doing public speaking, but not everybody does. And so some folks, that, maybe don't enjoy standing up and doing the dog and pony show as much as I do, they can do this as basically like a conference call. And that's how I, always encourage my panelists on a webinar to treat it. We want it to be as interactive as the format will allow us to be. We do have, as Nick said, the ability to take questions, and we encourage you to submit them. We've had some webinars recently where we had so many questions that we had to, literally cut it off at the top of the hour. And then we had some where we had, fewer questions and we got out a little bit early. Either way is fine. We're okay with that. We encourage you to ask those questions. I'm going to kick a few of this. I'm going to kind of kick the problem off a little bit, and then I'll kind of turn it over to Steve. But one of the great benefits that we have today is, Nick's on here, and he is a fabulous speaker and podcaster. If you haven't listened to his podcast, totally encourage you to do that. And he'll kind of be our master of ceremonies today, too. So that's kind of where we are. I want to go ahead and kick into the PowerPoint. And excuse me, my mouse went a little bit too fast there. So, what is it that we're here to talk about today? So, the problem that we're talking about is insurance tracking. We're going to talk a little bit about the scope of insurance issues and then work our way into tracking. And we'll share with you why we believe that's important. Then we're going to talk about some recent technology and data and process innovations. Obviously, data and analytics are always a big deal in the marketplace. We'll talk to you a little bit about some of the stuff that we're doing. Brian and Diana will talk about some of the stuff they're doing. Steve, I think, will fill all the gaps and really help us understand, kind of what's current or emerging best practice in this area. And then the last thing, we really always want you to leave one of these things with the ability to take this back to your shop and do something with it, whether you're an auto lender or an investor in the auto loans themselves. We're going to talk about, again, what the implications are of these advances, notably for things like borrower outreach. We always talk about that. We'll talk about loss mitigation, both from the standpoint of the borrower's perspective, traditional credit loss, if you will, and also collateral loss mitigation or losses related to the underlying, in this case, vehicles. And then the last thing, and this is really important, is we're going to talk about the implications on disaster prep and recovery. We've already had our first storm of the year, Florence, which, I saw an estimate yesterday that $50 billion of potential damage. Obviously, it's way early for those estimates to be real, but enough of a number to get people interested in it. So anyway, so who do we have on the group? I introduced myself before. With me here in Dallas is Steve Garcia. He's our Director of Auto Claims. And Steve came to us from a background of independent auto finance companies, notably some very large subprime shops where he had built a ton of very innovative approaches to loss mitigation, both on the borrower and the collateral side. So we've been happy to have him as part of our team. We also have Diana Maldonado from Westlake Financial Services. She's the Director of Insurance. It's possible that she may be running a few minutes late. They've been pretty busy, and so we'll get her incorporated as best we can. And then, last and certainly not least, we have Brian Massey from Nissan Motor. Brian is the Director of Collections and Loss Recovery at Nissan, and we're really thrilled to have him. We feel like, we got a great mix of talent and experience on this panel. We obviously got prime and subprime, backgrounds covered, independents and captives. We've got all these folks have tons of experience with insurance and collections and loss recovery. So we feel like that you're going to get a lot out of their presentations today, and we're looking forward to it. So, drilling into the meat of the webinar, thinking about how we got interested in this particular segment of the financial services industry. So, a little bit of background: my company, DeMont, is the largest provider of insurance claims services in the mortgage business, and we've been around for over 20 years. And a few years ago, we decided to look at the auto finance segment. And one thing that we didn't understand completely when we got into the segment is just how much of a problem the lack of insurance is in this segment. I mean, on houses, and I guess when you think about it, the size of the principal balances alone would dictate that you don't really have uninsured collateral in the mortgage business, right? But you have a lot of uninsured collateral in the auto finance segment. And so when we started looking at this and we found out, well, gosh, we have, or Dallas, not Houston, we have a problem. We need to figure this out. This is some data from, a study that was out there by the Insurance Research Council as of 2015. 1 in 8 motorists are uninsured, and that's a shocking number on its face, but let me give you some more color on that, okay? So, that 1 in 8 uninsured motorists, that's out of the population of motorists that actually are licensed drivers, okay? So obviously there's a population of drivers out there. Hopefully none of them are operating your vehicles that you all have liens upon, but there's a population of those guys, and my guess is that the percentage of uninsured is extremely high in that population, if not 100%. But if you look at this population, okay, 1 in 8 motorists is uninsured. Well, what does that mean? Well, there are 200 million licensed drivers in the United States, okay? So what that means is that there are over 25 million uninsured drivers out there on the roads today. I mean, that is a wow. For those of you that don't have, your uninsured or UIM maxed out on your personal coverages, I would recommend that you call your insurance agent after this and make sure you take care of that for yourself, because if you happen to run into one of these people or they run into you, it's a bad day, obviously, for you and also for whoever, if somebody's financed your vehicle, whoever has the lien on it. So that's a big number. That means that probably almost everybody has some degree of exposure to uninsured. And so, again, that's a big number, 1 in 8. I would ask the panel, right, just go ahead and stop, pause for a second. Is that consistent with what you guys have seen in your experience, in your careers?
Yeah, so I do believe it's consistent in our experience and what we've seen, and it's always interesting as you look at this. We haven't monitored insurance for some time now, and we really see the impact of that on the back end in collections as they go into total loss deficiency, so forth. So it's an interesting case, and we are looking for ways to try to mitigate that and try to understand how do we correct this, and then appropriately what do we do to change the behavior.
Yeah, definitely. And I, 1 in 8, living in subprime for the majority of my career, unfortunately, I would love to see 1 in 8 because that's kind of low for us, right? So, really typically and we'll cover this later on, but yeah, it's even more heightened, and for subprime lenders, it's definitely more impactful on that side of the business for sure.
Yeah. Coming down from 30,000 feet a little bit, so I thought the first thing to do would be to try to slice and dice the data a little bit and go, okay, let's look at the geographies. And so this is also in the same report, and this report is easily obtainable. You can Google it, or if you would like to get a copy of a PDF, send Steve or me a note afterwards, and we'll get it out to you. But anyway, so this is the state-by-state distribution of the uninsured drivers. And, I look at this, every time I look at this, I'm like, wow, it's hard to discern patterns that make sense to me, right? Gosh, I guess everything these days is now colored by, the political environment in our country, and red versus blue and all this kind of stuff. And you look at this, map, and it doesn't really seem to shake out that way. You have, very high exposure to uninsured drivers in places like California, in Florida and Michigan that are big population states, but then you also have, Tennessee, Mississippi, Alabama, Arkansas, right, that are relatively lower in population. You see Texas and Illinois and Ohio and New Jersey kind of coming up in the second, Maryland in second place, but then they're also joined by places like Oregon and Colorado, Missouri, so, and then you see, a fairly, low degree of exposure to this concern kind of in the upper Midwest or west of the country, and in the Northeast, and then you see in North Carolina seems to me to be a bit of an outlier. And ironically enough, the only state in our country that does not require insurance is New Hampshire, and it's a fairly low state. So I'm surprised by that. So Brian, Steve, how do you guys look at this, and how does that compare with your experience?
Yeah. So as I look at this map, it's interesting to me. As I look at the states, especially on the top of the list, my average loss is much higher than those states than the ones that are on the lower half of the list, which I think there's some correlation there to the insurance piece. It's definitely interesting. They're not all high volume states as far as from a business standpoint, but Florida is definitely an issue for us.
Yeah, and I'll even, one of the things that sticks out to me on this piece is, each state has their own set of rules, set of laws that they follow from an insurance perspective. Some states are naturally more aggressive on uninsured drivers than others. So, taking a state like Georgia, who is kind of still, sitting at a 12%, so kind of in that middle of the pack road. That's a state that's very aggressive with their uninsured drivers. They actually follow up. There's cancellation notices, suspension of licenses that they issue. They're far more aggressive than any other state that I've seen out there on uninsured drivers. Yet they still battle a 12% uninsured rate, even with everything that they have in place. So that's one of the things that really stick out to me on this side of it, for sure.
Yeah, interesting color. So I think what we're trying to figure out is the correlation between, insurance and credit risk, right? And so if you start to drill down to the next layer, I think that's when you kind of look at some of the data from the standpoint of, what's the penetration or lack thereof, I should say, in terms of insurance from either subprime or prime portfolios. And as you can see, our generic media sources are showing, well over double the lack of insurance in subprime versus prime. That makes intuitive sense to me. How do you feel about those numbers, Steve?
Yeah, so like on these, I mean, these are kind of numbers that I even see, with tracking, right? So I can only imagine how much lower they'd be without tracking. And while you see a significantly higher rate on subprime, 10 to 15% on prime isn't anything to kind of just say, okay, we're good with that, because quite honestly, from a prime perspective, you're dealing with a much higher vehicle values and much higher losses. Should anything happen with that car that's not covered, right? So, it took, 35 to 40% in subprime could be a $12,000 balance, but 10-15% in prime that's a $40,000 car a lot of times. So at least, right? So while the percentage is lower, the loss impact is higher for those guys in the prime market for sure.
Yeah. Brian, do you have any color on this slide?
Yeah, I would just add, you look at that 10 to 15% on prime, and he's right, because you are looking at probably higher dollar amounts and higher LTVs. And then when you look at it from a holistic perspective, you're also looking at smaller margins, right? So which makes it that much more important to be able to secure as much as you can as far as from a collection standpoint, because that could get away from you really quick at 10 to 15%.
Yeah, that's a great point. And I think, ultimately, whether you perceive insurance information as a component of a credit, risk problem or a driver of a credit risk problem, I think we've established that there's a case out there that says, you really need to, have some visibility in terms of, what the insured status is for your collateral. And obviously there's been precedent for doing that in the industry. And there are, insurance tracking models that have been out there for a very long time. I thought that it would be a good time for Steve to kind of talk just a little bit about, what we have seen with those particular models.
Yeah, no, definitely. So, we've been in the, as Dennis said, we've been in the insurance claims business for over 20 years. We've been in the auto for over 3 years, specifically in auto. And, we've met with, in upwards north of 50 lenders across the country, talking through their solutions, talking through what they see, what they do today, what did they do in the past? Have they changed anything? And, the overwhelming feedback that we got can be kind of summed up in 3 categories. What we found is lenders are definitely moving away from forced place insurance. They've done the cost analysis on forced place, and just from a cost perspective, it didn't really make sense for them. It wasn't really outweighing the losses that they were saving, and the delinquency that they were forcing, because payments were going up for customers and so forth and so on. It didn't outweigh the cost of the product itself.
Is that consistent across different types of lenders, whether it's subprime or prime?
It's definitely consistent across that medium to lower, to subprime market. There still are lenders in the prime market, particularly what I've seen so far that are still actively doing it, or more in the credit union, in that world. They're still really actively into the forced place insurance for sure.
Brian, has that been kind of, do you think that prime lenders are also moving away from that CPI product?
Yeah, from my perspective, I think a lot have, obviously, because number one, there's the cost of tracking, and then the cost of the insurance force place, and then the collection of it if necessary. So it's a very outdated model at this point.
Okay, so even despite some of the risks, the upside's not there.
Yeah, I mean, just the other damages that they were forcing delinquency, forcing loss, accelerating loss. It just didn't make sense.
Okay.
The other piece is the data, right? So your tracking provider, a lot of lenders just didn't have access to that very critical data, which they could use to kind of build into, some other areas of, into their collection strategies, different types of campaigns that they could run across the board. That was another big drop off.
For those that aren't familiar with it, what are the mechanics of insurance tracking in general?
I mean, essentially what you're doing is you're collecting policy updates from carriers on your portfolio, right? So it's essentially, all that information that's coming in, whether it's, a new policy notifications, cancellations, reinstated policies, added drivers and different things like that, any kind of policy change, that they go from a full coverage to a liability only policy. Well, a lot of that stuff's very critical and very key to what, any kind of lender, whether they're prime or subprime, could actually benefit from, getting that data and incorporating it into their strategy and into a type of a borrower outreach program. If I've got a $45,000 car out there, a loan, an asset out there, and either that policy gets canceled or it gets converted into a liability only policy, I've got some concerns on my end. That should trigger something on my end as a lender to I need to get somebody on this call, to figure out what's going on with that.
So if they don't have access to the data, how is it transmitted?
Essentially what we could do is we build files for our current lenders.
No, in the past, or
it's really just what we've seen is it was just basically being stored at the tracking solution at the provider itself, right? So there was really no transmission of it. They took care of everything. They did very manual mode. So it was just a lot of paper coming in, a lot of paper notifications coming in, and then paper going out to the borrowers who had a canceled policy, letting them know, and hey, your policy's canceled and so forth and so on. But quite honestly, letter campaigns nowadays we live in a day and age where the mail is just constantly falling off as far as the importance of it.
Okay. Hey, Brian, do you have a comment on that point of the slide?
No, I think it covers that. We haven't had this process in place at Nissan for a long time, so it's no more comments.
Okay.
Yeah, and that's actually a perfect transition to kind of the next deal is, lenders, it was just a costly solution, especially for subprime, it's needed, right? These are high risk borrowers, you have to know, and even how as bad as it's needed in the subprime, it seems the cost of tracking has kind of even pushed subprime lenders to just go ahead and accept that, hey, you know what, it's okay, I'd rather not incur that monthly cost, because it's too costly for me, right? So, but even more so on the captive side, that captives that have these 1 million, 2 million, 3 million loan portfolios, to sit there and track and pay per loan per month to track insurance, it just doesn't make sense. It didn't make sense for them. So what you have and what we've seen over the past 2 years is, and through our conversations with these lenders, large and small, is they just pulled out of the market just because of the overall cost of the product.
So, I mean, if they can't pay for it, what have they been doing, if anything, internally? Is it? Brian said he doesn't do anything, right?
Yeah, that's the thing. They just made the decision to just say, you know what, we'll live with what we live with, and that's kind of our solution right now. That's kind of it's kind of a forced upon solution right now.
Kind of leaves you like it's unsecured loan, right?
Mm-hmm. Yep.
Okay. Well, that doesn't obviously make sense. So what are some of the things that you guys have done to kind of bridge that gap a little bit?
So what we've done is, we've essentially created a more data-driven solution, giving lenders, the ability to get back in the market of tracking, right? And we've been able to leverage some all of the, the relationships that we have with the insurance carriers, the insurance provider, because quite honestly, the more lenders that we can push back into tracking, the lower their costs are, because they no longer have to mail those notices. For some of your captives, they're getting 300,000 or 400,000 letters a month. And that's just mail, that's processing mail, that's everything. So we can put lenders back in this market with a different solution, not a different, but a more enhanced solution, right, than what's out there today. It's a win-win for both carriers, for us, for our lenders, because what we've done is essentially built this product, and we're connected, electronically with all the carriers, right? We've got about a 92% coverage rate through our electronic connections with carriers. All those updates are now just coming electronically. That gets fed to us on a daily basis, on a nightly basis. Anytime there's a change that's on a policy for one of our lenders, we capture that. And then what we do is we clean the data and then push it back to our lenders so they can either use it for their collection practices, their strategies, their borrower outreach programs. And it's a much cheaper solution. We've kind of done away with the old traditional, let's send out 3 letters per cancellation. We've kind of dispelled that whole philosophy, because quite honestly, there was really no ability to really track how important or how impactful those letters were. But every time you send it, it's $1 a letter, because you're paying for postage and you're paying for printing. So who is absorbing that cost? It ain't your tracking company. It was your lenders that were absorbing that cost. And so what we've done is basically taken all that, we've streamlined it, we've just used data, and we've given the power back to our lenders so they can, because I've always felt, hey, I'd rather have my guy, my collector, my customer service rep contact our customer, about non-insured collateral, about any situation, versus just sending a letter out. I'm going to have a better impact and a better outcome of that situation using my own person than a letter.
Makes sense to me. Brian, you have anything to add to what Steve was talking about?
No, I think the concept makes sense.
Okay. All right. So let's talk about, and we can linger over this slide for a while. Let's talk about some use cases for the data. I mean, I think that, it's only, every conference you go to, people talk about data analytics, and sometimes I'll joke in some of my speeches about how that seems to be the stock answer for every problem, right? But it really is true that every time you start thinking about, when you have data, more data is better than not, right? And then when you start thinking about different ways you can do stuff, I'm always amazed at some of the things I hear people talk about that they're using data for. So, this slide lists a handful of items here. I don't need to read them. Y'all can read them yourselves. But this is where I think really, Steve and Brian, we'd love to hear from you guys in terms of how you see that. All of a sudden having that data, what does that mean for you?
Yeah, so from my perspective, having that data, you're able to put that into your collection scorecard, and you're able to understand how should we go after, how should we process that customer differently than we normally would with those who have insurance in place. The fraud detection, I think, is a big one, because those are typically the ones where you won't have insurance in place. You can put a process in place to start reviewing for fraud, and then that can go back to the dealer so that you're able to avoid the loss at all. And it does improve your process speed, right? So if you know how to plan and go forward with these customers, you're able to put together a more effective strategy to mitigate loss, whether it means picking up the car sooner, whether it means doing some things with the customer to try to get insurance in place if it's not a fraud. So yeah, the data makes all the difference. It's just got to be a point that makes sense financially.
Yeah, you hit on the scorecard, and I kind of want to touch on that piece, because I thought, just in our conversations and with our current lenders and seeing how they're using it live and how it's impacting, different scores, that score, triggers essentially everything that they have, whether if they want to reinstate a customer, if they want to do a deferment for a customer, how often they want to call a customer, how early do they call a customer, at what level, is it just through a dialer campaign, through a manual campaign? So there's a lot of this score, there's this data that's feeding into that score is actually triggering a lot of different types of decision making, automated decision making as well for our lenders. So if you get a customer who's in a 30-day range, right, but they were paying their insurance, they've got active insurance, well, that customer is naturally less of a risk than somebody who's at 30 days past due and just got a cancellation notice, right? So obviously, I can leave my 30-day customer who's still paying through their insurance and other things, I don't have to put so much pressure on them, but this one right here, it elevates it, right? And it pushes it into a more high risk type deal. And that was kind of the beauty of this product, and that's kind of what I've learned too, is how impactful and how the insurance data is actually a really good predictor of future default and future loss. So that's just on the collection strategies alone, it's been a huge impact.
So I would assume that a promise to pay from a borrower that is current on their insurance, if you knew that, is more valuable to you than one that's not. Right?
Oh yeah. You're risking it's just a different level of risk there.
Can you imagine a scenario where you would reach out to a borrower that is current, but yet you knew that their insurance was not current?
Oh yeah, I mean that definitely happens. And what it tells you, because it could tell you a couple of different things. It could tell you, this borrower has made their car payment a prioritization, right? Even through some other things. Now there are other things that I can do to help them on that side. If I know that this customer is paying but their insurance lapsed or their insurance canceled, I could probably use a little bit different, more softer technique with that customer, right? So it provides a level of urgency. It gives that collector, whoever is making that phone call, or customer service rep, whoever is taking the phone call, it gives them a little bit better clarity on what kind of customer they have on the phone at that time.
I mean, I suppose there's a risk for some false positives, right? I mean, they could be sitting around watching the football game and decide, they saw a commercial and they can save some money by switching carriers, right? And so you're going to know that. But it also could be that they lost their job, or God forbid, had some kind of health issue or something like that that's impacting them, right?
Yeah, no, it could be. I mean, if you have a customer who's gone through that situation and they were in a current state, it allows you to maybe give them a deferment, right? Because that's a customer who is, they were current. Something obviously happened in their life that impacted, income, right? So it allows you to make a better decision on how much assistance you want to give that customer, for sure.
I mean, we saw earlier a pretty significant correlation between the credit quality and the presence or absence of insurance. What kind of correlations do you guys see? And I'll start out with Brian. What kind of correlations do you see between the velocity of insurance change and the credit quality? In other words, are your subprime? How often do your subprime borrowers, swap insurance? I mean, how big of a shoppers are your borrowers, whether they're prime or subprime, in the insurance marketplace? Do you know?
Yeah, I would tell you, Dennis, since we don't track, I really don't have data behind that. But I think the theory would be that those guys are the ones that would be shopping more often.
I shows you I'm a lawyer by trade. I should never ask a question I don't know the answer to. I mean, I should have known that. I missed that one. Sorry. I try to add humor to my speeches, and I usually get good audience feedback. But this format doesn't work for that, so we'll just laugh amongst ourselves, or I'll laugh at my. Steve, what about in subprime?
So I'll tell you right now, just from what the data that we see is, we see anywhere between 5 to 6 times the amount of policy updates, policy changes, on an annual basis on a subprime customer than you do on a prime customer.
Yes, I would agree, Steve. It's Diana from Westlake.
Hey, Diana. How's it going?
Welcome, Diana.
Good, thanks. Hi, good morning, everyone. Good morning on my side. I don't know if it's still morning on your side, maybe afternoon. But I agree with Steve.
We're starting to have fun, so you joined at the right time.
Perfect. Thank you. We see it about 6 to 7 times within the life cycle of the loan, and it could change by carrier. But another thing that we noticed is that some loans perform better depending on the carrier. So if a customer takes the opportunity to shop with a better insurance carrier, then likely their loan is going to perform better as well.
And I mean, there are carriers out there that specifically target, subprime customers, and with these low entry points of cost from a policy standpoint, and So yeah, that's definitely the case. We see that play out across other segments. For sure.
Okay, so I want to rewind that for a second because I was just so thrilled that we had our group here that you're telling me, Diana, that if they shop for a better carrier, they're going to perform better. I guess that makes sense, right?
Yes. Yes. So you have your customers, like, for example, if they go with Geico, Farmers, Progressive, they'll do better than your General or Western General, Dairyland, right? Ocean Harbor type insurance carrier. Yeah.
So if you knew that they switched from, I'm not going to name names because insurance companies, don't like us enough to begin with. So I don't need more enemies, right? But hey, so if they shift from a high cost carrier to a more mainline carrier, and you knew that, then that would change your treatment for that borrower. You could theoretically adjust your loss reserves a little bit, right?
Yes. So that's helped us with a collection strategy. That's helped us with having, offering deferments and knowing when or predicting when a customer would make a payment. The likelihood of it.
Oh yeah.
That's very powerful. Super cool.
Oh yeah. No, it is. I mean, and she even kind of talked about collections, but you're talking. We have a couple other bullets on here, skip recoveries, those customers that don't want to be found, right? They're using that data for that every day.
You mean they're borrowers that don't pay, that don't want to be found?
Yeah. Probably more so in Diana's world than Brian's world, but I'm sure Brian has his fair share of them.
So how's this data going to help you find them?
So typically, on my end, on our end, typically the phone number doesn't change often. And they're readily available. They have multiple phone numbers that they've shared with us, cell phones, home, emails. Typically, the customer who gives us very limited information is the customer with the different insurance carrier, the not so well-known insurance carrier.
Yep. And we're, like I said, when we're getting these updates, we're collecting everything. That's on that policy. And what's on that policy is direct customer information that we're pushing back to our lenders. So they're, like I said, when we push all this data back, they're getting it, they're housing it, and then now they have a history of addresses, something that they have essentially paid for, up to this point, through different types of skip research tools and websites. We're actually able to provide them a lot of this data, and it's just included in what we're already doing for them.
Wow.
Yeah, some insight on the skip recovery. So our collections group uses the insurance notifications that we get. Typically, it lists the customer's current address on there. So we use that address, or our collections group uses that address for the skip tracing purposes, if it's different than what we currently have.
Okay. So one thing, just going down the list, fraud, I would assume that there's a fair amount of fraud as it relates to people, saying that they have insurance and they don't, or, signing up to binders when they first, get the car.
Never following through, yeah.
What can we do? What can this data help in that regard?
Well, typically what we've worked out with some of our lenders is triggers, right? So we can push them this data, right? So they'll know when a new policy is in place. So a lot of our lenders have built in different types of triggers to where if they're not receiving an update within a certain amount of time of funding that loan, so they take it back just a couple of steps, but fraud is mostly going to be involved in your early pay, on your newer loans, on your early pays, and it's a huge impact on any lender's early pay defaults, right? And a lot of it happens at the dealership level, quite honestly. So what we do is, and we've got it set up to where lenders have different triggers, and if they're not getting an update from us on a specific VIN number, it's triggering something on their end to essentially escalate that into a potential fraud situation. So even in the case where we'll get an update and then we'll get a new policy and then we'll get a cancellation the very next day, well, we let our lenders know, hey, this policy was active for 1 day. So this is something that you guys need to take a look at on your end, and it helps alleviate a lot of this fraud and helps them catch it up front, to where they can go back to dealerships, pursue unwinds and different things like that while it's still early. It's very hard. The longer that it goes in the process, the harder it is to pursue, getting that loan basically taken off your books. So catching it early is very critical for them.
I would assume those people get gone quite quickly.
Yeah. Especially the ones that live down south by the borders. Yeah.
So, there's a lot of collection stuff in here. There's obviously a lot of, skip recovery and fraud pieces. Obviously, I think repo claims is a fairly obvious thing. Is there some more coloration you want to give around that?
Yeah, I mean, now that we have, so what, again, once we start, this process for our lenders, we're capturing the entire history of of their policy, right, or of their insurance on that car. So we're catching all the switches from like one carrier to another, and then back to that same carrier. What were the deductible amounts, and what were the policy terms, and how long did that policy last? So what happens is, when these lenders are getting back, if that customer falls into a default situation and the lender has to take action through a repossession, we can actually now, if there are damages on that car, the lender, typically, in the older days, they were just saying, oh, you know what, we'll just have to sell it as is, and we'll absorb the loss. We'll absorb the losses. We've built some of those losses into our models up front, so we know that there's going to be those types of losses. Now, what we've done is this process. When the lenders are getting their cars and those cars are arriving at auction with all these damages, now that we have an insurance history for their customer, we're able to pursue those losses for that lender. So we're basically collecting on losses that they had already forecasted being losses. So it turns into a situation where it's found money for our lenders.
I mean, I would assume that repoed vehicles have a high degree of damage to them.
Yeah.
Right? Love to hear from our lenders on the panel, just at a 30,000 foot level. What do you guys think that means to you guys from a loss number on your recoveries, the repos that you do recover, just on an annualized basis?
I think on our end, it's an improvement in terms of a percentage, at least a 7% increase on helping with repo losses. Right? These are losses that we're going to take anyway, and we're collecting something on the repo claim. Finding out about the damage after the fact. So just a little statistics. We typically don't know about a claim if we find out until after roughly 2 months after the date of loss. So within those 2 months, if you have a customer in the subprime world who just cannot afford repairs, does not have insurance, they're going to abandon that vehicle. Likely we repossess it and it has that damage. And it has also an insurance policy that we could file a claim against. So on our end, we see a 7% increase on the losses as it relates to repos just from the claim. And that's significant just based on portfolio size.
And obviously Brian is not tracking, but I'm assuming you may have some idea of kind of, what you guys are seeing in terms of even the amount of cars that come across that are damaged when you repossess them.
Yeah, we definitely see that, and we're actually in the process of putting a process in place to try to collect on that, to be more like what Diana's doing at Westlake, because it makes sense at the end of the day on those particular vehicles to be able to go back after the claim, because you don't necessarily see it until you see the values come back from the auction.
Yeah, for sure. Okay. I think it was good to linger over this slide a bit. We obviously there's a lot of different use cases, I would think, for this data, and probably if you check back in a year, we'll probably have 4 or 5 more that we hadn't thought about, right? But unless anybody else has anything else, I wanted to kind of move on to the last slide that we've got in our presentation anyway. by the way, we're tracking pretty much to my experience on webinars. We typically spend, 40 to 50 minutes talking through a PowerPoint. And so we're going to talk about the transition in a way that seems a little bit different, but is very much related, and that is, natural disasters, right? So I think collateral losses stem from either, people not paying, or from, something happening to the collateral, from, a hurricane or fires or what have you. And as I said at the top of the webinar, we've had our first storm of the year, and that's been pretty devastating. Obviously, hearts out for those folks that are going through that in that area. But to start off the conversation, I guess, with fire starters, we had a number out there. I always look at these numbers and I go, who knows where they came from? But at least Fortune says there were 1 million cars damaged in Harvey and Irma. I think that's a good number. In fact, it's probably light. We saw a tremendous, number here in Texas. They took one of the local speedways and turned it into a gigantic lot for damaged cars, and so, we're used to that. What I have on the right is a screenshot that, because of the coloration, it's harder to understand, but this is from a snapshot from a data visualization. So one of the things that we started doing last year, as I said, we do an awful lot of claims volume in both segments. And so we started putting out, just as a service to the industry, kind of predictive modeling in terms of what we thought the damage would be in the storm-affected regions. So this is a screenshot from, what we put out there a couple of weeks ago as it relates to Florence. And you can go to our website and you can run this thing. The pop-up is still, valid. And obviously the storm damage is a little bit different than what the original FEMA disaster zones were going to be. But what that is showing you, when you go look at it, stacked bars, is you can see just in an aggregate and a percentage basis, the number of claims that we normally see, in any given time period versus what we were predicting to see based upon heuristics from all the past hurricanes that we've tracked as a company. And again, this is proprietary data based upon the bench of loans that we look at, but there's a lot of them. So it's pretty good. Your mileage may vary, but it gives you an idea. And, the little visualization probably takes 2 or 3 minutes to run. It's pretty cool if you want to go check it out. So just to kind of kick this conversation off, I really wanted to hear from, Diana and Brian in terms of, what you guys are thinking about in terms of disaster preparedness. What are some takeaways potentially or best practices you might share with the lenders in the audience? And then kind of with an eye towards, what is it going to mean for you in terms of claims, you think, on the vehicles?
So from a prime perspective, typically when you have a disaster like a hurricane or fires even, which have been a big concern lately in California, typically you're starting the extension process as a way to get relief during the situation. And then it takes probably a good 30 to 60 days to really start seeing the claim processes, the volume of it come in. And, I was looking at a report earlier today, and just from Harvey and Irma, just this year, we've processed over 1,200 total loss accounts. And those were accounts that had insurance and not necessarily full balance charge-offs. So it's interesting, the impact, and then how long that impact lingers for a lender and a customer, essentially.
For us, it's very similar. Yeah. For us, it's very similar. We actually, the 30 to 45 day mark is when we start hearing back from our customers, right? They have to wait until electricity is restored. Sometimes they're sending us emails and letting us know, hey, we're we're going to need to file a claim with our insurance carrier. We just haven't made any contact. We just want to let you know our power is not on yet, or whatever the case may be. But it typically does take the 30 to 45 days. What we've done, at least for in the past for hurricanes such as Irma and Harvey, we know that there are other avenues that our customers could use. So not only their primary insurance, if they have it, right, but if they don't have the primary insurance, then we suggest like FEMA assistance, right? Sometimes FEMA helps with paying for, mortgages or vehicles in times of need. So we suggest those things when we're speaking to our customers if we identify that they don't have insurance. But in terms of a preventative measure, the only thing that we can do on our side for the products that we offer is basically continue to offer them while insurance carriers are closing down. You should say, I know we had this for Harvey. I know, large insurance companies were just closing in terms of not offering any more policies for the affected area. So we kept ours available for our customers during that time so that they could at least have coverage if they opted to.
That's great. Steve? Oh, I know you've been talking to some carriers, right? Not all of them, hate us, right? And actually,
in one area,
we help each other out,
yeah,
when we can, right? Especially in storm season when everybody's hammered, right?
Yeah, no, there's
What are they telling you about what they've seen thus far?
Definitely the Florence one was definitely impactful, not as impactful as last year's were. I mean,
Right.
Last year, this one particular carrier, but within the two, I think they lost over 40,000 cars, or had to settle out on 40,000 cars, and this one is it's still out there, right?
Yeah.
I mean, right now, it's the smaller region. Obviously, this carrier is currently sitting at about 1,500 to 2,000 right now that they're looking at right now. But again, they're still coming in, right? They're still flowing in, so it's still pretty early to get that final number on the Florence one this year. I mean, the big thing that I'll take, that I've seen is, these carriers, they essentially will assign adjusters that'll travel out to these areas, impact areas, and they're just running through, right? It's like it's a shop, right? I mean, it's just, it's an assembly line almost for doing an estimate on a car. A lot of them are just resulting in total losses, but what we've been able to help our lenders with is more, and then also the customers, especially customers that don't have like gap insurance or any kind of insurance protection outside of the traditional, comprehensive and collision coverage on their cars is, we're helping our lenders by giving them, data around the values of that car, to ensure that they're capturing as much as from a recovery standpoint that they can, and for these customers, because the last thing that a customer wants to be left with is a deficiency balance after going through a natural disaster. So we're helping our lenders kind of help, it's helping with our lenders recoup some losses, and it's also helping with the customer not having to carry over such a high deficiency balance on their end, because we know these carriers, the way that they're pumping these things through, they're just trying to get them paid out and getting as far as least as possible. So we know they're not in the business to pay out the maximum amount, but it's kind of our job to get the maximum amount. So that's kind of where we kind of help our lenders in these situations, for sure.
Yeah, that's a great point. I mean, these things need to get solved quickly. You've got a stressful situation, and these people, need help. And the last thing you need to be doing is prolonging, the anxiety over an issue like a deficiency or something like that, right?
Oh yeah.
Yeah, that's a great point. Obviously, I think Diana, you made a great point too about the gestation period, if you will, on the claims. I mean, for us, it's even a little bit longer than that, because we're going to find out about the claims sometime after you guys do. And so I think, Brian, you made the point, these things go on for a long time, and we're still processing a lot of claims from last season, and now we're already in the next season as it is, and so it'll be interesting to see what the final take is. I was looking at numbers on the Harvey and Irma last year, and then again, where these numbers come from, I got no idea, but $400 or $500 billion, who knows what the final take is going to be on those things. but what's interesting is there's a lot of work to do in both segments, to talk about these issues and figure out how the industry can better serve the borrowers, and that's something that we spend an awful lot of time doing. We convened a special summit before the storm season began back in June. We had people from FEMA in and talking about some of these things, and some of our lenders like to be more proactive with their borrowers in terms of providing suggestions about things they can do, and some do not. It's just everyone's policies are a little bit different, but I think there's no right or wrong way to deal with a disaster as much as it is just to prepare for it the way that your company thinks is appropriate. And we're going to get to see some stuff here firsthand. We go down to Puerto Rico in November for a follow-on summit about some of the damage from down there. So it'll be interesting to feed that back to the industry as we learn about the recovery process that's going on down there. Anything else from the panelists that you guys feel like are good takeaways for the audience here, Steve or Diana or Brian?
Yeah, I think we've covered quite a bit on my end from our solutions, how we help our lenders, how we even help the carrier. I'll be interested to hear what Diana and Brian, if they have any other takeaways as well.
You guys have anything else to add?
Nothing. I think we've pretty much covered it, and I think I came in at the right time when we were discussing insurance tracking. I think that's very important. That truly is the future. Electronic tracking is the biggest thing, right? I feel like insurance companies do business in the 20th century, very Flintstone age, by sending paper notifications. But I really think email, web-based, electronic data is really where we're going to make the most impact. Imagine knowing when a claim or a policy cancels in real time, and then being able to make changes, whether it's on practices internally, collections, or allowing the customer more time, or just being more cautious, right? We have an interest in these assets. So I think that's probably the most informative and most beneficial tool that we're going to have. At least we're starting to see it on our end.
Excellent. Brian, you have the last word. Anything to add from your perspective?
Well, I think from my perspective and looking at it from a prime outlook, we, like I said earlier, we run on much narrower margins than subprime. And I think what we're starting to realize, at least at Nissan, is this is an important thing that we need to monitor and that we need to pay attention to, because while the losses aren't huge necessarily for us, the risk is there. We need to be ready and facilitate this risk in a way that keeps the portfolio safe and doesn't put it at risk. And when you see these big storms, that's usually when you really get an indication of how much risk you have on the books from an insurance standpoint, because it really exacerbates no insurance, especially when you're not tracking. It becomes more of a surprise each time, and that's not a good way to go.
Yeah, for sure. Awesome. Well, I've been monitoring the questions, and it looks like we covered everything. Again, I really want to thank our panelists, Brian and Diana and Steve. And Diana, you did show up at a great time. It's perfect. Appreciate it. And thank our audience for joining us. And Nick, I really appreciate it as always. And look forward to seeing you out at Used Car Week. And I'll turn it back over to you.
And again, thank you so very much for joining us. Just a reminder, we have recorded today's session, so please keep watch of your inbox for a link to the recording to be able to review the great information and insights that our entire panelists have shared. So for everyone on the panel, Ryan Massey from Nissan Motor Acceptance, Diana Maldonado from Westlake Financial Services, as well as Dennis Brosnan and Steve Garcia from Diamond. I'm Nick Zulovich from Cherokee Media Group. We thank you so very much for joining us, and we look forward to having you again next time.